Okay, next we're going to continue with our differential analysis, and we're going to look at, should I make it or should I buy it? Sometimes it's often better for me to go out and buy a part than actually to make it. But I have to look at all components. And also this happens a lot in automobile manufacturers or manufacturing in general. So I'm an automobile manufacturer and I've been buying a panel for $240 a unit and I operate at 80% of capacity. This is extremely important because if I'm not at a 100% capacity and I choose to make it, that allows me to make it without incurring additional production costs. So if I choose to make it, the cost is going to be broken down as this. I'm going to pay direct materials, direct labor, variable factory overhead, and fixed. So the cost to actually make is $280. Now right away your first instinct is to say, wait a minute, it costs this to make, it costs this to buy. Right away you should buy it. Well, you really need to do the differential analysis chart to determine that. So remember, I did say that alternative one is what I normally been doing, but in this case I'm not going to do that. Alternative one is to make the panel. Alternative two is to buy the panel. And then we'll look at the differential effect if I continue doing alternative two. So selling price is not even going to come into play here. This is revenue. I'm not actually selling this. It's all about cost here. So here's my cost for making the panels. Purchase price, nothing. I don't buy it, so it's zero. Here's my direct materials, my direct labor, my variable factory overhead, and my fixed, which equals, it's going to cost me $280 per unit. If I buy it, it's going to cost me $280, but I will not incur any DM, DL, or variable factory overhead, but fixed factory overhead still has to continue because no matter what, I have to pay fixed. So when I look at the differential effect on income, if I decide to buy, here's what it looks like. Again, revenues or sales prices not even into the picture right now. So if I take the difference between here and here, I'm losing $240. The difference between these numbers, I'm gaining $80 if I buy it. I'm gaining $80 if I buy it. I'm gaining $52, but I still have to pay my fixed factory. So when I take the total down, I'm actually losing money to continue buying it out for $240. So I'm losing $28 per unit. So in this case, what should I do is I should make the panels. So this is how the differential analysis on a make or buy usually works. Typically on a make or buy, it's better to make it because you still have your fixed factory no matter what. Next slide, we're going to look at, should I replace equipment that's worn out, even though I'm still using it? So replace equipment. So just because equipment's worn out or totally depreciated, I can still use it. So I'm going to look at differential analysis about should I replace my equipment. And remember, book value is irrelevant here. So here are my information. Here's my old piece of equipment. It cost, my book value is $100,000. Again, this is irrelevant. It costs me $225,000 a year just to use it. And at the end of the time, I could actually sell it for $25,000. Or if I buy new equipment, I could sell this equipment for $25,000, and it has 5 years left. If I want to buy the new equipment, it's going to cost me $250,000, but it's going to still cost me $150,000 annually for 5 years to run it. There is no residual value, and here's my life. So here's my chart, and so this is alternative one is continue what I'm doing. That's the status quo. Alternative two is to buy a new piece of equipment. And we're going to look at differential effect on income if I decide to replace it. So here's my revenue. The revenue would be the selling of the machine. So there is no revenue if I continue, but I will increase my revenue by $25,000 because I'll sell my old equipment if I buy new one. Here's my cost. No purchase price cost if I keep doing what I'm doing, but I will spend $250,000 to buy new ones. So again, it's going to cost me $250,000. It's going to increase my cost. Remember, it was over 5 years, so my variable cost that I pay regardless right now times 5 years is what I'm doing. But if I buy new equipment, I'm actually going to be saving $375,000. So now I work down. I come down, add, subtract, add, and my overall net is positive. Whenever this is positive, you should do alternative 2. So just so you know, remember, this is the as far as revenue that I'm giving up, this is something called opportunity cost. What you give up to do something else is called opportunity cost. Okay, finally, on the next video, we're going to be doing 2 things. We're going to talk about process or sell or accept special business. Thank you.